Good evening and welcome to our market wrap. Let's get straight to the numbers. The Nasdaq closed at 717.54 on the QQQ, up a modest 0.08%. The S&P 500, tracked by the SPY, finished at 745.64, a gain of 0.2%. The Dow Jones Industrial Average added 0.58%, closing at 50,579.70. The VIX, our fear gauge, eased 0.66% to settle at 16.59. Over in the bond market, the 10-year Treasury yield dipped 0.61% to 4.56. The dollar index edged lower by 0.08% to 99.24, while the offshore yuan strengthened slightly against the greenback, gaining 0.1% to 6.7826. Now, commodities were a mixed bag, and oil was the big story. WTI crude plunged more than 7%, closing at $90.53 a barrel. Gold, on the other hand, held firm, rising 1.02% to $4,576.10. Bitcoin also saw a small uptick, finishing at $77,096.22. Sector performance tells a tale of two markets. On the winning side, energy stocks surged over 7%, and information technology added 1.21%. But consumer discretionary took a hit, falling 3.04%. Over in China, the National Chip Fund concept and advanced packaging sectors were strong, while Chinese brokerages and innovative drug stocks lagged. So how do we characterize today's session? I would call it a structural rotation within a sideways, low-volume market. The headline indices barely moved, but underneath the surface, money was flowing in a very specific direction. Capital is rotating out of commodity markets that are sensitive to geopolitical headlines, like crude oil, and pouring into tech growth stocks, particularly anything related to artificial intelligence. Some money also moved into gold as a hedge. This is not a broad-based risk-on move. It is an extreme concentration of capital into a single, high-conviction theme. Let's walk through the global trading day. In Asia, Chinese and Hong Kong markets opened higher and stayed there, picking up the momentum from last Friday's tech rally in the US. Semiconductors and AI applications led the charge. European data was sparse, so we cannot draw strong conclusions about the intermediate transmission. In the US, stocks opened on a positive note, continuing the Asian optimism. Tech, and especially chips, remained strong throughout the session. There was some intraday volatility, but the money never left the tech trade. The real action was a rotation within sectors, not a change in the overall direction. The key inflection point today was not in equities. It was in commodities. WTI crude suffered an intraday flash crash on expectations of progress in US-Iran negotiations. The leaders today were AI and semiconductor stocks, which completely ignored the macro noise and continued to attract capital. The laggard was crude oil, whose collapse reflects a rapid unwinding of geopolitical risk premium. There are a few important expectation gaps worth highlighting. First, the market ignored at least three pieces of negative news today. Number 1, Fed hawk Christopher Waller reinforced the case for further rate hikes, which sent short-term Treasury yields spiking. Tech stocks did not even flinch. The market has either fully priced in the near-term rate impact, or it believes the long-term AI growth story simply overwhelms interest rate concerns. Number 2, Wall Street banks collectively downgraded their short-term gold outlook, yet gold still closed higher. The market is clearly prioritizing long-term geopolitical uncertainty and de-dollarization over near-term rate pressure. Number 3, China's securities regulator moved to crack down on illegal cross-border securities operations. This only had a targeted impact on US-listed Chinese stocks. It did not spill over into the broader Chinese or Hong Kong markets, suggesting risk isolation is working. Perhaps the most significant structural signal today was the complete decoupling of risk pricing between equity markets and commodity markets. Tech stocks rallied on AI optimism, which is a classic risk-on move. At the same time, crude oil crashed on geopolitical détente, which is a classic risk-off move. These two events happened on the same day without interfering with each other. This tells us the market has entered a phase dominated by a single, powerful narrative. AI and traditional correlation analysis is breaking down. Now let's look at the three-way linkage. The dollar edged lower, giving non-US assets some breathing room. Equities in the US and China strengthened in tandem, especially in the tech sector. In the bond market, the 10-year yield fell, but the 2-year yield hit a new high. The yield curve steepened in an inverted direction, reflecting market fears of near-term tightening and a potential slowdown in long-term growth. What does this mean for Asian markets tomorrow? Near-term liquidity and risk sentiment are supportive for a positive open. However, we need to be cautious. The bond market is flashing a medium-term recession signal that could reassert itself at any time and disrupt sentiment. So what is the game plan for tomorrow? The dominant theme remains AI tech. The degree of concentration in this trade is still increasing. However, the structural fragmentation in the market is real. Sector rotation can happen quickly, and overall stability is not guaranteed. Our strategy is to be long, but with controlled position sizing. Focus on the AI theme, but keep leverage in check. If the Nasdaq 100 futures hold a gain of more than 0.3% before the Asian Open, and if WTI crude stabilizes above $90 without making a new low, then it is reasonable to add selective exposure to semiconductor and AI-related ETFs in China and Hong Kong. However, if the Nasdaq 100 futures turn negative by more than 0.5%, or if WTI crude breaks below $89, then we should abandon all pre-market positioning and move to the sidelines. Finally, keep an eye on these invalidation signals. If the QQQ breaks below its key support at $710, if the dollar index quickly rallies above 99.5, or if US-Iran negotiations break down and crude oil jumps above $95, then our current strategy of being long with controlled risk is immediately invalidated. That wraps up our coverage for today. Thank you for watching, and we will see you tomorrow.